Hey everyone, good afternoon. It's Denise Donahue, the Mortgage Nerd. Today I'm going to talk to you guys about our seniors loan. Sometimes these have a negative connotation out there, and it's largely because people are not educated about them. But if you've got elderly parents like myself, I know sometimes it can be stressful thinking about where they're going to live and how they're going to pay their mortgage. And so I wanted to share this with you because, quite frankly, a lot of people just aren't aware of it. But it's a way for seniors, specifically 62 years or older, can buy a home or refinance a home that they're in now to keep that roof over the head and not have to go through moving. They've got memories in that home and not have a mortgage payment. And it's not a scam. The bank doesn't keep your house. It works very much like any other loan. Again, there's just a lot of negative connotation. So let me explain it to you guys. Basically, what you're looking at is, let's say you're going to do this as a purchase. You're going to buy a home and the house is worth $400,000. Maybe they want to be closer to you, closer to the grandkids, and they've got that $400,000 in a retirement account, but should they take that money and dump it into a home, because your home is not a liquid asset, meaning if something were to happen and you needed those funds, you can't easily access that money. So your options is to pay for the house in cash so that there's no mortgage payment, or you keep that money into what I call the savings account, where the money is still earning interest, it's compounding every single month, and you can access it if something were to happen to them. So the question becomes, well, how do you buy a house then if you don't pay cash and not have a payment? Well, you use a program called our seniors loan program. It still requires about 50% down. So you would need $200,000, which is better than $400,000. That other $200,000 can be earning compound interest over here. You take $200,000 and you buy the home. Now, normally when you buy a house, you have what's called a principal and interest payment. And so every single time you make a mortgage payment, a portion of the payment goes towards principal to pay this loan balance down, and the interest part goes to the bank, the cost of borrowing funds. It's no different, except the bank doesn't require a payment. Now, what happens is, instead of your parents or somebody that you know that's using this type of program, instead of them taking money out of their pocket or their retirement or their pension every single month to have to make this mortgage payment, instead there's no payment. We don't care. The bank doesn't care, and really the elderly person doesn't care about the principal part. They don't care if they pay down this loan balance, because essentially what they're doing is they're keeping a roof over their head until they pass. I know that sounds maybe a little jaded, but it's just the truth. At the end of the day, they need a roof over their head. And so they don't really care about paying this down, because the asset's going to pass on to their family regardless. So, but how does the bank make their money? Well, the bank still earns interest. And the way that they earn interest is, instead of this money coming from their pocket, what they do is they charge you against the loan every single month. So instead of your loan balance going down, if the interest charge was $100 every single month, let's say, then your loan balance started out at $200K. Now it's at $200,000, 100. Then the next month it goes to $200,200. And so the bank is still earning interest, but you don't have to take that money out of your pocket when people are on a fixed income for the mortgage payment, because it's just being rolled in. So let's say, let's fast forward 10 years from now, and let's say this loan balance grew to $300,000. 10 years passes by, interest has grown, and now your parents have passed. What happens with the asset? Same thing as if they were to buy this home with any other loan. If the house is worth $500,000, then you have the option to sell the house and you keep the equity, or you keep the house in the family and somebody else moves into it. Maybe you rent it out, but it's the exact same concept as if you were to buy the house with any other loan product. People think that with this type of loan program, the bank keeps the house and they keep the equity, but that's not the case at all. So it's an easy way for your parents, let's say, to buy a home or refinance a home if they're strapped for cash and they have retirement income, and that income only lasts to pay their bills and their medical expenses, and they're stressed out. We don't really want our parents stressed in the last stage of their life. This is a way to keep them in their home. There's such an emotional attachment to people in their house. They've got memories in that home. It's not a scam. The interest rate is comparable to what you would pay on a normal 30-year fixed rate. The bank doesn't keep the money. Again, there's just a lot of misconceptions out there. So I just wanted to share this loan program. It's, again, only for people who are 62 years or older. So if you've got parents or if you've got friends and family and you're stressed about them being able to make the mortgage payment, it might be something to consider. So I just wanted to share that with you guys. If you have questions, you know how to get a hold of me. Thanks for tuning in. Bye-bye.